Welcome back to another in-depth episode where we dive into strategies that can genuinely shift the way you view markets. Today, we're exploring a topic that's both an art and a science: candlestick patterns. If you've ever stared at a chart and wondered why certain candles seem to have more weight than others, this episode is for you. We're going beyond colors and shapes, we're decoding the story behind every candle, understanding the battle between buyers and sellers, and learning how to use this knowledge to make smarter trading decisions. Candlestick charts, as many of you know, originated in Japan in the 18th century, initially for rice trading. These charts weren't just functional, they were a visual narrative of market psychology. Over time, traders realized that the shape and sequence of these candles could reveal sentiment, momentum, and potential reversals. Today, candlesticks are a cornerstone of technical analysis across every market, from Forex to equities, commodities to cryptocurrencies. Each candle is like a mini storyboard. It contains 4 key pieces of information: the opening price, the closing price, the high, and the low. The body represents the difference between the open and close, while the wicks, or shadows, tell us the extremes of price movement during that period. Let's dissect this further. A bullish candlestick forms when the closing price is higher than the opening price, typically represented in green or white. This indicates that buyers dominated during the period. Conversely, a bearish candle forms when the closing price is lower than the opening price, usually shown in red or black, signaling seller dominance. But here's where it gets interesting: the wicks. A long upper wick can indicate selling pressure at higher levels, even in a bullish candle. A long lower wick may suggest buyers stepping in to support prices during a down move. The nuance in these wicks often reveals the tension in the market, where the battle for control is happening in real time. Now, let's move into patterns. Candlestick patterns can be classified into single, double, and triple formations. Single candlestick patterns, such as the Doji, hammer, and shooting star, are powerful because they can reveal immediate sentiment. A Doji, with its small body, tells us that neither buyers nor sellers are in control, market indecision is at play. If you spot a Doji at the top of an uptrend, it's a warning sign that bullish momentum may be fading. A hammer, on the other hand, has a long lower wick and a small body and typically forms at the bottom of a downtrend. It signals a potential reversal because buyers have absorbed selling pressure. The shooting star, its bearish counterpart, warns of a potential top during an uptrend. Double candlestick patterns, like the bullish and bearish engulfing patterns, provide more confirmation. A bullish engulfing occurs when a small bearish candle is followed by a larger bullish candle, engulfing it completely. This suggests that buyers have overwhelmed sellers and that an upward move could follow. The bearish engulfing pattern is the mirror image, a small bullish candle swallowed by a larger bearish candle, signaling a potential downward move. Triple patterns, such as the morning star and evening star, are even more powerful. These patterns capture shifts in market sentiment over multiple periods, reducing false signals and offering higher probability setups. The morning star, for instance, consists of a long bearish candle, a small indecisive candle, and a long bullish candle, signaling a strong potential reversal to the upside. Let me share a practical story to illustrate this. John, an experienced trader with 5 years in the markets, was analyzing the euro to US dollar pair during a period of unusual volatility. On the daily chart, he identified a bullish engulfing pattern after a downtrend, a clear signal that buyers were starting to take control. A few days later, a doji appeared, signaling indecision in the market. John didn't rush in. He waited for further confirmation. Soon after, a morning star formed, a sequence of long bearish, small indecisive, and long bullish candles. This triple candle pattern reinforced the bullish reversal signal. John entered a long position just above the high of the bullish engulfing candle and placed his stop loss below its low, carefully managing risk. Over the next several days, the market followed the bullish trajectory indicated by the patterns, allowing John to exit at a predetermined profit target. This story highlights an essential lesson: candlestick patterns work best when combined with context, support and resistance levels, trend direction, and market structure. A bullish engulfing at a key support level is far more significant than one occurring randomly in the middle of a trendless market. But candlesticks are not limited to Forex. In equities, a morning star at a crucial support level can precede a multi-day rally, while in commodities, a hammer after a steep decline in oil prices can indicate a rebound. Cryptocurrencies, notorious for their volatility, often present opportunities where the correct reading of a candlestick sequence can allow a trader to anticipate rapid reversals and momentum shifts. It's also critical to understand the psychology behind these patterns. Each candle reflects emotion, fear, greed, uncertainty, or conviction. A series of bullish candles may indicate growing optimism among traders, while a sequence of bearish candles shows mounting caution or panic selling. Recognizing these psychological cues allows you to anticipate market moves more accurately. For example, after a prolonged downtrend, spotting a hammer or morning star pattern suggests that sellers' momentum may be exhausted and buyers are stepping in. Here's a practical exercise for you. Over the next week, choose a market you actively trade. Each day, identify and document any notable candlestick patterns. Track what happens afterward. Which patterns led to meaningful moves? Which failed? Over time, this journaling habit will train your eye to recognize high-probability setups and refine your timing. Combine this with support and resistance levels, trend analysis, and volume, and you have a framework that transforms candlestick patterns from abstract visuals into a tangible edge in your trading toolkit. A quote I love from Steve Nyson, the pioneer who introduced candlestick analysis to the Western world, encapsulates this perfectly: "Candlesticks are like a language. The more fluent you become, the more clearly you understand the market." Fluency comes not just from memorization but from observation, practice, and reflection. Finally, a word on risk management. No candlestick pattern guarantees success. Patterns are probabilistic, not absolute. Always define your risk before entering a trade, set your stop losses, and ensure your position size aligns with your overall risk tolerance. Candlestick patterns enhance decision-making, but they should operate within a well-defined trading plan. Now, I want to hear from you. Which candlestick patterns have consistently provided high-probability setups for you? Do you rely more on single, double, or triple candle formations? And in which markets do you find them most reliable? Share your experiences in the comments. I want this episode to be an interactive learning experience, where we can all grow together. To wrap up, mastering candlestick patterns is more than an academic exercise. It's about learning to read the story of the market, understanding the psychology of participants, and translating that insight into actionable trades. Whether you're a beginner or an advanced trader, this skill will give you clarity in chaos, precision in volatility, and confidence in your trading decisions. Remember, every candle tells a story. Learn to read it. Respect the patterns. And let the market's narrative guide you to more informed, disciplined, and profitable trading.
Thank you for listening to the 101 Trading Tips in the Ultimate Trading Podcast, brought to you by bellsforex.com AudioWorks. We hope this episode gave you insights, perspective, and practical ideas to strengthen your trading mindset and improve your decision-making. Stay disciplined, keep learning, and remember, every trade is a step toward building your edge. If you found value in today's episode, don't forget to like, subscribe, and turn on notifications. Sharing the podcast with fellow traders helps us grow and bring even more free trading education to the community. Visit us anytime at bellsforex.com for resources, guides, and tools to support your trading journey. Until next time, trade smart, stay disciplined, and keep building your edge. Happy trading!